Let's talk about buying a protective put. And what is that? It is simply a type of contract that gives the holder the right to sell a specified quantity of an underlying asset at a certain price, which is called the strike price. And we can use this strategy, buying a protective put, to hedge against potential losses if an underlying asset decreases in value. So here's an example. Let's say you owned 100 shares of ABC stock. Maybe you're holding it for dividends. Who knows? Well, you could buy a protective put with a strike price that's equal to or slightly above the current market value of your stock. So if that stock was to decrease in value, you could exercise your put option, sell your shares at the higher strike price. It's going to limit your losses. Well, some traders are going to buy a put with a strike price less than the current stock price. It's up to you. So think of it like an insurance policy that protects you if the downside picks up steam. But on the other hand, if your stock increases in value, you then have the choice to either keep the shares or sell them on the open market for a profit. And a lot of people just close out options positions. They don't exercise them. But at the end of the day, protected puts are like a peace of mind. They're protection against market volatility. But there's always cost associated with trading. This is no different. So only use this strategy if you deem it necessary for whatever reason. So as mentioned, we can use the protective put to protect our portfolios from losses in the event of a downturn in the market like we're seeing here in 2022. So you would buy put options for each 100 shares of stock that you have in your portfolio. So if the market were to experience a sudden drop, these put options would increase in value, and it's going to offset the potential losses in the rest of your portfolio. Now, it's important to note that while a protective put can offer some degree of protection, it can also limit your potential gains. That's if the market was to rise up instead. And as with any trading strategy, it's really crucial that you weigh the potential risks and the benefits before implementing anything, and that includes protective puts. It's slightly bullish, right? Because we're kind of expecting the market to keep going up. We just don't know how fast. But at the same time, we know anything can happen, so we want to protect our downside. So the key to this is finding the right strike price for your put option. So it's got to meet your needs in terms of downside protection and not be too expensive. Because like I said, when you purchase a protected put, it's an insurance policy against the downside, and it's the right to sell the underlying stock at a set price. So the best case scenario, your stock rallies really high, your put expires worthless. Worst case, the stock drops. The put option will offset some of your losses that you're going to incur. So when's the best time to buy it? Well, usually when there's high implied volatility or when you expect some kind of market moving event. COVID was a great example. Now there's risks, again, associated with purchasing a protected put. We got time decay to worry about. We have opportunity cost. Overall, in the grand scheme of things, it's not a bad tool for hedging your portfolio. How do you do it? Again, you have to understand what your goals are going forward, okay? But the first thing you got to do, select the stock or the commodity that you intend to protect, determine the strike price you want to use and the expiration date of the option. And again, you got to own the underlying for the protective put, or you don't need a protective put. Second, you set up a trade as you would when you buy a put. Just confirm what strike price you want to use. So here's an example. Let's say you have 100 shares of Marvel stock and it costs you $39 a share, and you want to protect that position. So you would buy an out-of-the-money put option. In this example here, it's a strike price of $36. It's 32 days left to expiration. And let's say it cost you $1.66 in premium. Now that's per share. Remember, it's 100 shares per contract. So it's going to cost you $166. So this is going to give you the right to sell shares in Marvel for $36 anytime leading into the expiration date. It doesn't matter if the price drops to $31. It doesn't matter because you have that right to sell at 36. So moving forward, let's say the stock goes to $43. Well, you made $4 gain per share, or $400 if you were to sell your shares. But since that put expired above the strike price, you would take a loss on that. And that's going to be based on the premium you paid. In our example, it's $166. So your overall gain is actually your $400 minus the premium. So it's $234. That's if you sold. Now, price can also go down. So if the stock price is under the strike price and it falls to $31, you're going to book a loss on the shares that you have of $8. But that $36 strike price is in the money by $5 since that stock is now $31. Now, because you bought the protective put, you have mitigated your loss to $3 a share or $300. Remember, you also had to pay $1.66 to enter the trade though, right? That's your insurance. So your loss is actually capped at $4.66. It's a lot better than $8. So overall, you did take a loss, but your loss is lighter than it would have been. Instead of $800, you lost just over $450. So again, when you want to buy these, consider the market conditions. Generally speaking, it's a good option for you who have stocks that you want to hold on to for the long term, but you are worried about short-term market volatility. Again, if you're holding stocks for dividend payments, not a bad idea to think about these. It can provide peace of mind, right? If that sharp declines in value pretty quick. Now, timing is the most important thing when you purchase these. If the stock's value has already dropped significantly, well, it may not be worth it to invest in a protection at this point, right? Maybe just wait and see if the stock rebounds before you buy a protective put on that rally back up, if it comes. On the other hand, if that stock's value is currently really strong, but there are signs of potential market turbulence out there, buy a protective put beforehand. That can help hedge against potential losses. At the end of the day, however, you have to do your own research, keep an eye on the trending of the markets, and you decide when you have to protect to the downside. The risks, the cost, right? The price of the option plus any commissions, right? That can add up, could potentially eat into any profits gained from exercising your option. Also, there's a chance that the stock's not going to fall as far as you anticipate it. It might even rise, makes the protective put useless. There's timing. If a stock drops all of a sudden and you haven't purchased it yet, it's probably too late. But if you plan ahead and you can kind of see when the market's probably going to decline a little bit, you can properly time your transaction. A protective put can mitigate your risk and any potential losses. But again, I'll always say this, you alone, you have to weigh the potential benefits and the drawbacks before deciding whether or not to purchase a protective put or even to trade at all. Depending on the size of your portfolio, having it could be a good thing to do for insurance-wise. So let's have some quick hits here. What's a protective put? It's an option strategy. Buy a put option on a stock or other asset you own to protect the downside. Benefits? Again, helps mitigate risk, and it could help maximize your profit potential when the markets are volatile. Risks? You've got costs to worry about. It can eat into your profits if your stock starts to rally. At the end of the day, if you know you need to trade options, but you don't know which ones, I tell you right now, we like to use two dynamic ETFs, the SPY, the QQQ. They are among the most liquid ones out there. They have great volume, open interest. They also have opportunities each week. They have 3 different expiration cycles. And I'll be honest, trading options can seem daunting, but I think with this little PDF we have here for you, it can be a little bit easier, a little bit more profitable. We're going to show you how you can take advantage of this, what we call the dynamic duo. It's a totally free guide. The link is above, it's below. Make sure you pick it up. We'll talk to you soon.